Hi there, my name is Pat Gaughan, and welcome to the first of several screencasts on understanding balance sheets using a deductive approach. Basically what we're going to do here is we're going to start with a rather simple definition, in this case the definition of balance sheet, and ultimately you're going to realize that the accounting rules are actually the logical outcome of common sense and history. So it's your choice. You can use the traditional approach and memorize a bajillion rules, or you can simply understand the basic concepts and let the rules flow out. Okay, so let's get started, and we'll begin by looking at what this entire series is going to cover and what this individual screencast is going to be limited to. Basically, today we're going to cover items number 1 and number 2. We're going to start with basic common sense, understanding what is a balance sheet, and then we're going to begin to understand the relationship between assets and liabilities, the two of 3 main components on your balance sheet. In future screencasts, we will then go and realize the value that we can achieve if we look at order within each of the groupings. In other words, if assets is laid out systematically in groups, what additional information do we get rather than a haphazard list of assets? Likewise, if liabilities are laid out with some particular logic, what additional information can we get out of the list of liabilities? And then once that's done, we go to item number 4, where we start realizing that, hey, if assets and liabilities are both laid out in a systematic form, what additional information can we get by looking across the 2 lists? From there, we end up going in item number 5, looking at the problem of changing values. In other words, what happens when something deteriorates while it's sitting on your shelves? You know, what do you do when it decreases in value? Or it goes the other way. What happens if it's been sitting on the shelf so long it's now a collectible? We also discussed the need for an audit trail and also the basic role of depreciation. When all of that is done, in our last screencast, we will then end up discussing the additional value and information that is revealed if you have balance sheets at different times that are properly compiled. What type of additional information can we get if we compare them? But today we're going to focus on number 1 and number 2. So we're going to start right now just looking at the basics of what is a balance sheet. Now, what we're going to do here is we're going to stop. Take a deep breath. What you want to do is you want to look at this definition and don't go flying past it. A balance sheet is simply a list that shows the difference between what we own and what we owe at a given point in time. What you need to realize is that there are actually 4 key components in this definition. The first part is what we own, which is basically your assets. You can have a list of all the things that you own. What are all of your assets? Then you need to have another list, what we owe. This is your liabilities. Third, I want you to pause and ask yourself, what is so important about the difference between what we own and what we owe? If you let it sink in, eventually you'll realize that the difference between what the company owns and owes is really the owner's interest. Owners get whatever's left over. This is sometimes called shareholder equity. If you want, you can say it's the owner's interest. I don't care. But realize that if you look at the totals, the total assets minus the total liabilities tells you what the owners actually have a claim to. It's not just assets and liabilities, it's also the difference that's important. And then, at all points, you have to realize that a balance sheet is just a snapshot. It's not a running total. It is a snapshot of the difference between what you owe and what you own at a given point in time. Realizing that your assets and liabilities help you understand what the shareholders have an interest in, namely everything that's left over. Make sense? So, here's an example that I'm going to help you with. We're just going to work through this very quickly. If we're going to do a business plan, or we've just opened, assume these are all the things that you would need to open a lemonade stand. You need cash because you're going to have to make change. You need sugar, lemons, paper cups, water, an ice chest, blender, ice, bags, or bags of ice, orange crate, and a cardboard sign. Now, if you accept the values I've put in there, this is telling us that for us to open our lemonade stand, let's assume this is June 1st. Remember, it's one point in time. You need to have assets worth $128.81. Ta-da! We now know these are the assets. So, at this point, students who have been memorizing definitions and not understanding them start scratching their head because they don't know what else to do. That's when I get a phone call or someone shows up in my office and says, okay, I got this far. How do I fill out the rest of the balance sheet? My response is, well, you tell me. Where did you get your $128.81? They usually look at me blank-faced. And eventually what will come out is you either put the money in from the shareholders or you took a loan. And since we're Americans, we're probably going to start with a loan. So we have a loan, 128.81, and shareholder equity is here, right? We know from this equation that assets minus liabilities, remember it's the difference between what you owe and what you own. Whoopsie daisy. IBIL. In this case, 128.81 minus 128.81 equals 0. So what are we looking at? We understand the assets are worth 128.81. We have what we owe, liabilities of 128.81. And because the two are equal, what the owners have as a residual claim is 0. Congratulations, you have just reinvented the balance sheet as it probably existed around 1300. Now, you might ask yourself, why 1300? Well, somewhere around, I think it was 1394, you had a monk in Italy who realized that you could change this little equation. Assets minus liabilities equal shareholder equity could, in fact, be assets equals liabilities plus shareholder equity. Now, at this point, you're probably asking yourself, why do I care? Well, if you think about this, this is before computers were out there. If you use this new formula, using our layout here, you can basically manually total up two columns. 128.81 is equal to 128.81. In other words, manually, by shifting from this common sense approach to this slightly modified approach, you can manually check your balance by using what's called double entry accounting. Yay! I know, it's exciting. So what you find is students, when they start realizing this, they say, okay, so a plus over here must equal a plus over there. That's unfortunately wrong. Because if you think about it some more, you could have a plus over here with a separate entry that's a minus. That means there's no change on the other side. So for instance, assume that we're pre-making our lemonade and we have consumed inventory items of minus $3. But we now have inventory of plus $3. In this situation, the total assets remain 128.81. Assets and liabilities plus shareholder equity remains 128.81. So what you realize now is you're getting a much deeper feel for the allocation of what we own and what we owe, and realize that you can have shifts within this group or between the groups, which is why next time we meet, we're going to actually start discussing how the groupings within your assets and within your liabilities can give you more information about the differences and nature of what you owe and what you own. Any questions? If so, let me know, and have a nice day.